Yeah, I've been a business development professional in the Valley since 1994. Met a lot of the early, so I saw the first internet wave up front. I was an investor in a lot of companies in that space through Reuters, and then eventually started working with startups themselves. So it's been a pretty crazy ride in Silicon Valley the last 20 plus years. And this next wave of technology is interesting, really as interesting as all of the other things that you guys are going to be exposed to, whether it's IoT or robotics or AI. So this is just another area. In the e-discovery space, there's a lot of questions about what's going on with blockchains, and there's a lot of discussion, hype, how it's going to change everything you've ever known. It is the cure to cancer, but no one knows it yet. It is also an area that probably, like any nascent technology, gets a lot more hype than it can deliver right now. There will be a time where more will happen, but we're still at a very early stage of what's going on here. My hope is to really take you through, oh, I gotta figure out how to do that. Great, so this is really where I'm gonna spend some time talking about these topics, and the reason I'm doing this, so this isn't gonna be a talk focused on e-discovery, because before you get to e-discovery, you have to have a sense for what the heck are we talking about. And with any of these sections that I'm gonna discuss, I could spend a full day or week just in that area. So right now there's a lot going on. Imagine the internet in 1972, which most of you probably weren't even aware was around in 72, even though you were born and around, but nobody was aware of it. But it's really the nascent technology being seeded in different aspects. And so every industry is affected. Everyone is being touched in some way, but again, it's still very early days. So first thing I'm going to talk about is, we like to use a slide because it sometimes feels like this is what's going on. Every time there's a problem, somebody says, oh yes, there's a blockchain for that. I probably see 3 to 4 business plans a week on a blockchain-oriented topic in a different industry. And so it feels like everybody is taking the blockchain hammer and everything that they're trying to solve is the nail. And so it's a very strange thing that's happening. One would argue, it is arguable that there's a faith-based thing going on here. I mean, and I'm not gonna overplay that theme, but it really is at that level because there's very little that's actually happened insofar as solutions to major problems that have been talked about. So without that being there, you have to say, well, is everyone just wanting to believe the technology? And that's very possible. So again, we won't harp on this side of it, but let's get right into what's going on. So before we start with the generic topic of blockchains, we really have to start at the beginning with Bitcoin, because it was the first instantiation of a technology that leveraged the blockchain that was trying to solve a real problem. And so I wanted to put this quote up because I thought it was an important one. And this is from something Satoshi Nakamoto wrote in a forum with early people who were getting involved in trying to figure out Bitcoin with him. The root of the problem with conventional currency is that all the trust that's required to make it work. The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust. Banks must be trusted to hold our money and transfer it electronically, but they lend it out in waves of credit bubbles with barely a fraction in reserve. We have to trust them with our privacy, trust them not to let identity thieves drain our accounts. So put yourself in 2008. This is the beginning of the financial bubble where this explosion is happening. And here's some really upset people, and in this case, the pseudonymous Satoshi Nakamoto. We don't know who that really is. We don't know if it's a man or a woman or a team. We have no idea who it is. We only know that this figure, which in a way has created a myth around the founding of this token, but this person or people were trying to solve a very specific problem. And so they were really trying to solve this issue of how do we create in the digital world a way of paying people or having a cash-like instrument If you think back to the way digital information works, you can make a copy of everything, a perfect copy of any digital piece of content. So if we're going to create digital money, the theory would have it that, well, we could create a duplicate of that money. So if I pay a PIMO some money, I could take that exact same token, make a copy of it, and give it to somebody else. And so it wouldn't work as money. So something novel had to happen in order to create something that, A, I could pay people with in a peer-to-peer fashion. Second, that I could stop this double spend, which was what I was just describing, the notion of making a copy and passing it on. The other thing is that if you think of cash, when I give you that money, you have it and I don't. Okay, so you can't censor that. Once I've given you the money, there's no way that we can reverse that unless you choose to give it back to me. But if I give it to you and you happen to leave and go to another country, I can't get it back from you. So these are properties of cash which are very difficult to do online. Before Bitcoin, there was really no way to do these things. The second thing is the notion that I should be able to transact with anybody without knowing who they are. In other words, somebody's across the world from me and I need to send them money. How can I do that over this digital network without knowing who they are on the other end, but knowing that A, they will receive it, or vice versa, that if they send me money, that I will get it and it will be mine. So this notion of pseudonymity, misspelled. Okay, so in the case of pseudonymity of transactors, it's also this notion that while these are two addresses that are known to the network, we do not know who owns them. So I may have a private key address and a public key to match that, and you might know that, but you don't know that it's Pierre's public key or private key. You just know that I'm going to send money to that key, and that's all I need to know. And so this was a really interesting problem to try to solve, and it came out of a frustration with the current situation in the financial industry. So what you really have to focus on here, that this group or these people were focusing on a very specific problem. This isn't blockchain that you hear about. This is a very specific problem. But they felt that the novelty of this could be dealt with in some interesting ways. And so this blockchain concept is this notion of a digital public ledger. All right, so first I want to explain that when I'm going to describe a lot of this stuff, I'm really going to be speaking in metaphors. All of what you hear about cryptocurrencies is metaphors. Because when you get down to the bite side, or when you get down to the nuts and bolts of how this is all built, it really isn't what you hear. So, for example, somebody will tell you, I'm going to give you Bitcoin. And in your head, you think, okay, they say, I'm going to send it from my wallet to your wallet. So instantly, you start to develop ideas in your head. Oh, I have a wallet, and somebody is going to send me Bitcoin, and it's going to go into this wallet that I have. And I'm going to send them Bitcoin, and it's going to be this thing that's maybe like coins, maybe it's bills, maybe it's bits, but it's just going to be this Bitcoin thing. Well, that's not how it works. The reality is that the wallet is nothing. The wallet is the place where you keep your private key. That is all it is. It's a place that holds this number, this magical number, that only you have, and if somebody figures out the password to get to that thing, they can now be you. Okay, so that's how important this thing is. So it is a very important thing to keep secure, is this private key. So when you hear a wallet in the Bitcoin sense, it is only a container, a digital container that holds this really valuable thing. So that's where all the security has to be built into, is holding that key so nobody can get to it. All right. When I send you the Bitcoin, I'm actually not sending you anything. What's happening is that there's a ledger that has information about what is assigned to my account number, so to my public key. And so this ledger has every transaction that's ever happened, and in it, it shows that for whatever my ID is, there is 0.01 Bitcoin here. There's 0.0, and what it is it's not a positive, it is a inverse. So we call these unspent transaction outputs. I'm not going to talk a lot about this. I just wanted to say it because if you get into e-discovery issues around what's going on here, you do need to go deep. At the surface level, it will all look fine. When you go down into the nuts and bolts is where you start to find the evidence you need to understand who's moving what, when, and how. And so just keep that in mind that there is two levels, the conversational level of Bitcoin and what's really happening, okay? All right, so this distributed public ledger, there is a copy of this that sits on every node, and nodes are simply people downloading software that they're running on their machines, and there's two different types of nodes. There's one type of node that is a very active participant in the Bitcoin network, and this is a participant that is helping to create, to put the transactions in blocks, and the blocks on a chain, okay? So I'm speaking in metaphors again, but I'm gonna stay with that metaphor for a second before I explain a little more. So, these computers are competing, proof of work. There's a competition for who gets to take the transactions, the next set of transactions, putting them into a block, putting that block onto the chain, okay? So that competition has everybody running one of these mining nodes is competing to win, to be the one to do it. And what are they competing on? It is a mathematical game where they have to discover the answer to this puzzle, and once they do that, they get selected to put the next set of transactions that they choose off of the list of all the transactions everybody's doing around the world. They pick the next set that they're going to put into a block. Okay? They take that block, they put it and by putting it into this on the chain, what we're talking about, these are all files. So what's happening is the block is taking a cryptographic, a hash, which is oh man, as I use these words, I say to myself, what am I doing? Okay, so does anybody know what hashing is? Okay, so hashing is taking a piece of digital content and cryptographically turning it into ones and zeros, actually hexadecimal, so turning it into a 256 byte sized element, depending on the type of hash you're doing. But in the case of Bitcoin. So it's 250,000 bytes. Now, that, you can't reverse it, which means that if I take something and cryptographically hash it, I can't now have the hash and unwind to see what was in it. But if I have an original, I can tell super fast if it's inside of that. So it's called a one-way hash. And so it takes time to create it. It's very fast to validate, but it is impossible to reverse engineer it, okay? And if I want to create a fake, then it is very, very hard because I have to computationally do it from the moment of the thing I want to change, and every block, I have to recalculate that. But to recalculate it, I'm competing with other people who are trying to create the next block. So it's a cat and mouse game that even a nation state today could probably not fake a Bitcoin transaction or reorder the chain. Okay. The other thing that's happening here is that there's an economic incentive model that's built in to this process. So to be a miner, the reason you want to be a miner is for two reasons. One, because you want to be picked because the sum of the transaction fees that people have assigned to their transaction accrues to you, but also because you get a very special bonus. You get 12.5 Bitcoin. They are newly created Bitcoin that you win. It's a reward for doing the work. And so this reward, so 12.5 Bitcoin, today Bitcoin is at about $7,000. So we're talking about quite a nice prize. And it happens every 10 minutes. So every 10 minutes, someone has an opportunity to win the big prize, right? And as transaction fees have gone up, that number is a 12.5 plus the transaction fees, but the transaction fees today are still de minimis to that big reward. Now, every 4 years, that reward gets cut in half. So when Bitcoin started, this was at 50. Then it changed to 25, and then more recently to 12.5. We expect we will see another cut. Now, this economic model does two things. One, it incentivizes people who have no interest in what transactions are in the network or what's going on to contribute their resources to the network because they're doing it for the money. They're doing it to win, to get the reward, to get the transaction fees. They don't care what the transactions are for. If you think of it from a Visa perspective, its system is operating for the benefit of its customers and its bank partners. And so that's where the incentive is. Here, you've got people who have no interest in the financial world at all, who just have computers sitting idle that they can make things happen with it. These days, they're not sitting idle. These days, they're overtasked, and actually, they have to build up because the competition relies on how much processing power you have. So the more processing power you have, the better the chance that you win is. Having said that, anybody has a chance to win. It's still a statistical game. But the more you have, the more chances you have. So this is a way of having a network where there's an incentive for the participants to behave in the right way. The developers that support this also can make choices because they are the ones who facilitate the algorithms that these systems are running. So if the miners and the developers are at odds with each other, then you could have a standoff where nobody wins. The users, if they stop trusting the miners and the developers, then it can also become worthless. So you've got all these participants that are dancing in this balance, this very delicate balance that has made Bitcoin work. So clearly, where one might have stepped back and said at the beginning of this, oh, this will never work. Well, you know, now we've got, since 2009, to prove that, well, actually, no, it really does work. And once the machine started going, the incentives got bigger and bigger. The cost, the token, which when it started was worthless or worth pennies, is now worth a lot. The biggest cost in Bitcoin today, the amount of electricity it costs to run all of the machines in the network. So the way a Bitcoin miner thinks of the economics of what they're doing, the cost of electricity is the most important thing. If they see a cost of, you know, in California, we pay somewhere in the, I don't know, 12 to 25 cents per kilowatt hour. That's way out of line for a miner. They're looking at sub 4 cents, just to give you a sense, which is why you see Washington and Oregon where there's hydropower. And that's where a lot of mining operations are set up. In China, there's incentives that the government provides in certain areas, economic areas, and that's where some mining is going on. So suffice it to say, electricity is really the big cost in all of this, not the computers that they use. Okay, now I'm going to diverge a little bit. That was a little bit about the history of what Bitcoin is and Bitcoin. There's this other thing that has happened called private and permissioned blockchains. Now, private and permissioned blockchains were intended for, they arose at a time where Bitcoin was viewed as a negative. It was viewed as the home of illicit Silk Road, where drugs were being sold, and really uses that people really didn't care for. The dark markets, in every type of dark market you can imagine, Bitcoin was being used. And the reason was, just like it has been in most of the history of the internet, it is always those industries that have the first immediate use case for technology. So in the adult industry, the first credit card payment systems all made it into the adult world very quickly. Video was very big in that world before there was widespread use. Today, we take all of these things for granted, but in 1994, when I saw the first video over IP, I was not seeing it because it was somebody who wanted to have a conversation with me. It was usually, hey, we've got this new porn service, and now there's video. It's like, wow, you know, and there's a business model. Who knew? And that same thing happened in Bitcoin. So there was, if I wanted to buy drugs online, how would I have done it? Well, I couldn't use Visa. I couldn't use MasterCard. So credit cards are out. I'm not going to mail you a check. You know, that's not going to work. So how could you do it? Well, if you had a digital currency where once the recipient got it, they could hold on to it, then it was up to the buyer to make a determination. Do I trust this person to send it to me once I send them this thing? And lo and behold, it worked. And it worked in a big way. And the first drug markets closed fairly quickly, but it didn't take long before the next one. Silk Road got really big. And right after Silk Road went down, 4 new ones came out that were even bigger. One was called Alpha Point or something like that, no, Alpha something. Alpha Bay, right. Hey, a connoisseur.
That's all I know about.
Oh, okay. So this was really insane what started to happen. And again, it was showing that there was a use case, but people started to think about this and say, wow, what other things could happen? So moving money between here and another country depends on which country. So oftentimes you'll hear people talk about Western Union. Oh, they're so pricey. Well, actually they're not. If you send money to Mexico, it's 2% at best. And it's a very competitive corridor because there's a lot of money moving between the US and Mexico. But if you want to send money to Tanzania, you're probably into the 16 to 20% range. So if I want to send money to Tanzania, is it cheaper to do it with Western Union or Bitcoin? Well, it very quickly became evident that for certain markets, that was a much better way to send money. Okay, and it could happen instantly. And by instantly, we're saying it takes about 10 minutes for the processing to happen. Back when Bitcoin started, it really did move at about the speed of every 10 minutes. Today, every transaction is being put into blocks in 10 minutes, but it can take like 90 minutes before a transaction has actually happened. And that's because there's such a backlog of transactions that it takes a while to get them through. As well, you usually want to wait past 6 transactions to make sure that a transaction that was previously done was accepted by the network. So there's little details that force that. But suffice it to say that in that world, that was the use case for the public Bitcoin. But people started to look at the blockchain idea and saying, wow, that's so powerful for money. I bet there's other use cases for this. And all of a sudden, it was like an explosion because there was such a negative attitude against Bitcoin because of its illicit uses that investors were looking at people talking about blockchains for other use cases, whether it was in the financial industry, whether it was in the healthcare industry. All of a sudden, and in healthcare and financial services, they would all say, look, the data we're dealing with is very private, very personal. We can't let this be out there in the public markets. It's not meant to be seen by the public. But what they were missing in that line of thinking was that there's a number of things that Bitcoin was touting that people were associating with private blockchains, but that weren't really there. So for example, permissionless, censorship resistance, pseudonymity of transactions. Okay. Why would you want a private blockchain to be immutable or irreversible? If I have a group of trading partners, let's say we take 10 banks that are working together, and somebody makes a mistake, well, we want to be able to fix it, just like we would do in a database. We would edit the record. Maybe there's a process for how that's done, there's a process for approving that, but it would happen. If I know everyone who is going to be there, does it need to be permissionless? Do I have to build in the technology to make sure that anyone can hop into this network? No, I'm only going to allow banks that are registered to be part of this network, and they have to fill out a form, and they have to be admitted into the network. And so, again, these are capabilities that Bitcoin didn't require, or features that it had that you didn't really need in a private or permissioned blockchain world. Some industries actually learned the hard way. So I'll give you an example. There is the financial industry. There's a large consortium with over 100 banks that joined, called R3. For the first 2 years of their entry into the blockchain world, they did over 100 proof of concepts. Now, this is with a consortium of banks participating, all wanting to explore this thing. 100 proof of concepts. They had a 5-stage cycle for how things moved from the first stage of proof of concept to the second stage to the third. By the time I got to the 5th, that would be the decider that it was a real thing, and they would make an application of it and go to market with it. Out of 150, only 3 made it to like a level 3. 1 made it to level 4, and none went to market. This was after 2 or 3 years of proof of concepts. Okay, so just to give you a sense that, yes, it looks like this technology can be used for many things. But don't forget, in the Bitcoin world, it wasn't to help the financial industry. It wasn't to help the middlemen. It was to replace them. It was to change the dynamic. So when the folks whose dynamics being changed try to be the ones to drive progress or change, didn't really work. We've seen this in a lot of industries, and I'll talk a little bit later about how we're seeing these things manifest themselves now. But it certainly wasn't as people thought it would happen. So blockchains are very good for storing hash data. They're not very good for large amounts of unhashed data. So frequently you'll hear people say, hey, we should put that on a blockchain. Well, in a blockchain, you don't store the actual content. It's not like a database. It's hashed data. And as I mentioned with hashed data, it's encrypted. So you are able to see that it's there, but you can't tell what's in the hash. And so it's a way to say, I can timestamp that data. And I'm saying, at this particular point in time, I put this thing up there. Here is the original, and from the original, you can tell that it's inside of this hash. So if I went to court, for example, and somebody said to me, hey, that contract you guys signed, that's a forgery. Say, okay, well, let's hash that document. Let's take the digital version of that. Let's do a hash of it and see if it's in the proof or in the hash that's in the blockchain. If you can match those up and it looks good, then that's definitively proof that on that date and time on the blockchain, that document was put on there. Okay? So this is what's really interesting about hashing data. Its use is different than the use that you would have it in a database. You'll still need the databases to keep the originals. Blockchains are good for transparency of activity. They're not good when information gleaned from activity is undesirable. What the banks learned really fast is for this talk of we all trust each other and we want to work together on a network. Bank of America does not want Wells Fargo to know the number of transactions per second they're processing through a network. Just the way it is. It's a competitive issue. Okay, and so the amount of activity that you're producing in a network does not necessarily mean that you want to share that with your trading partners. You don't want your suppliers to know, you don't want your customers to know, you don't want your competitors to know. These are things that even if you can't see the actual data, seeing the velocity of data gives you a lot of information. Think of it as metadata about what's going on. Decentralized, and one other thing about transparency, transparency is an undesirable feature in competitive markets. So everyone thinks that they want to be transparent. They don't. If you think of anything that you do today with respect to commerce, the reason it works is because of asymmetric information. I know something the other person doesn't. When I sell a product at a store, I know what my cost is and you don't. And what you're buying is the convenience of getting it from me here, but if you knew that I was making 4 times the amount of money that you could by going to that other supplier, you'd probably figure out a way to get to that other supplier. So this is the thing, it's about asymmetric information. So we actually do not want transparency if you're an economic entity. So keep that in mind. It's always when you hear those keywords, always start to nod your head, go, yeah, sounds good, but, okay. DLTs, digital ledger technology. So blockchains are frequently referred to as digital ledgers. But the difference is that the way they work is that you're taking this group of transactions, putting them into a block, putting that block on a chain. That process is time consuming. It takes time because you have a process that goes and selects the transactions, groups them, encrypts them, and then encrypts the previous block to them. All right, those are steps that from a computer perspective, they take time. And it has to be done in a certain order. It has to be done with a certain amount of trust. The economic model's got to be operating. All of these things have to be in sync. Well, why is that necessary? If the application you're running is one where, gee, as fast as things happen, I want to put them into the chain as fast as they're happening. I don't want to wait and every 10 minutes do a batch job to do this. Once again, I'll use you as an example because you work for Visa, right? So in the case of Visa, Visa's not sitting there going, oh, we're going to batch all these transactions. And then, 10 minutes later, did my transaction get approved? That's not the way it works. I'm at the store, approve me, do the transaction, get it into the network. So DLTs are really the answer to that. They're inspired by blockchains, but they do none of the block stuff. They also don't require an incentive model because the participants are all trading partners that are incentivized to work together. So what they're getting, the benefit they're getting is immediate settlement. So if I want two sides of a transaction, two trading partners, the way it works in a lot of financial applications is they run settlement systems on the back end, and then they compare with each other, and if there's a debate, then they have a discussion over why there's a discrepancy in the transaction. Well, what if one settlement settled it on both sides? The LTs can help with that. And so that's a very specific thing. It is not what blockchain for Bitcoin was doing, okay? And so this is not to say that this is bad. It's simply saying that the technology, the problem objective that this is solving for is different than what you hear in some of the other ones. The key incentives piece. So we talked about this trust of trading partners. Well, trading partners don't actually trust each other as much as we think. All right, so I'll give you an example. You might have heard of something called the LIBOR scandal. LIBOR is the interest rate that banks charge each other. 5 banks colluded with each other to fix the prices. Well, that meant that every other bank was not part of the ones colluding. So if you're anybody other than the 5 banks, do you trust the banks? No, you don't. You don't trust the people you're in associations with, people you have dinner with, people you have drinks with, you go party with, you don't trust them. And so anytime that the incentives are this generic trust, I always question that. What's interesting, again, in the Bitcoin world is that the trust was based on this economic model where bad behavior got economically punished or where bad behavior ostracized you from the group. So it wasn't because of just some generic goodness of heart that we trust each other. All right, I'll move into another public blockchain very quickly. Ethereum, you will have heard a lot about this. Ethereum, so today you have to think of blockchains like memes. And if you don't know what a meme is, it means simply an idea. Okay, and so in this case, so Bitcoin is considered digital gold. That's really the simple way people describe it. Ethereum is world computer. And what that meant was that now you could create a blockchain where inside of the blocks were actual programmable pieces. So programs would be running inside of that. So all of these computers are running a copy of the blockchain and are all able to execute programs called smart contracts based on conditions in the network. So what's an example of a condition? So today in a standard database, you can do something called running a stored procedure, which means that when something changes in the database, a program is kicked off and it runs and it takes some action. Here, same thing. So on this blockchain, for example, I could say that every time I see a payment from a recording studio to an artist, at the moment those two accounts transact, the money to the artist should then be split with the producer, some of the musicians, so that it doesn't just go to the one party. At the moment it hits, it goes to all of these other places. And so that would be an example of a smart contract that operates on a network. The Ethereum blockchain was the first to really support this idea. And so Vitalik was a big fan of Bitcoins, but he felt that it was lacking in certain areas, and he thought that something more exciting could be done, and that's where Ethereum was born, out of this desire to say, hey, we can do all these programmable things. The challenge that Ethereum is running into is twofold. First, it has excited people to no end, and it has led to the world of ICOs that you have heard probably a little bit about when you hear about cryptocurrencies and ICO frauds and token launches. All of these keywords were inspired by this platform because one of the early smart contracts that was developed was one that let you create new tokens on the Ethereum blockchain. So this is really meta, okay? This blockchain that operates with these tokens called Ether can have programs written that create a whole new set of tokens, baby tokens. And so this is, like I said, it's very meta because the notion that the thing that uses tokens can create this new thing that uses sub-tokens in the same network starts to really freak you out. What would really freak you out if I start talking about gas, which is what it needs to run those programs. So it gets very tricky. But nonetheless, I want to expose you to these concepts because there is no lack of information on the internet about all of this. So hopefully these are keywords that'll tap your knowledge as you look into this and go, oh, I get it. Let me look deeper into that section. So these, what I've got here is a little bit of just the history that in 2013 is when it was announced. 2014, he wrote the white paper in 2013. 2014, it was announced that they had the beginnings of a working system. The technical specification for the part of the system that runs the programs was released. And then towards the end or middle of 2014, they released a crowd sale. This was the first ICO ever. And what this meant is I'm going to pre-sell these tokens that you need to use this network before anything works. Okay? Now, think through that a little bit. Someone convinced a lot of people that this thing that they were building was going to be so great that they should pre-buy the tickets of admission to use that amusement park. Sounds like, what is it, timeshares. We're going to be building it big here. Come on in, pre-buy, That's what was happening. Now, that is in essence what has been happening since this. So all of these things called ICOs are a funding model that resembles this notion. Now, the tricky thing is that in the US, we have these things called securities laws. And they have some very specific rules around how you can fundraise, what you can promise, what you can do, what has to be in place for it to be considered a security or something else. And so the jury's still out on whether the Ethereum Foundation will be found in violation of some of these things, but there's a lot of conversation around this, even though it took place 3 years ago. Ethereum is an open source public blockchain. This is actually a really mouthful because if you look at this description, Ethereum is an open source public blockchain-based distributed computing platform and operating system featuring smart contract scripting functionality. Wow. So when I say that this isn't yet at prime time where it's a consumer type of thing, I'm not joking. This is really hard. And so when you hear your friends say, I'm buying cryptocurrency and I'm doing stuff and this is hot, it's not because they have some depth of knowledge into what these things do, okay? It is the notion that they're excited by the idea of it. And they're gamblers, even if they don't understand that they're gambling. So Ether is the name of the cryptocurrency used in Ethereum. This is the cryptocurrency you need in order to participate in the network, whether it is to push your smart contracts or pay for the use of that smart contract by other people. And so there's a price to pay. The reason that there's a price to pay is because this is a shared resource, so it was a way to balance or coordinate how these widespread resources were being used. The smart contract I described before. And then there's this notion that when these blockchains came out, especially Ethereum is the particular case because it was a programmable blockchain. The notion is that when you put the program out there, it has to run. And it has to run kind of perfectly because taking it out is hard, stopping it is hard, and issuing a new one to take over the old one's functionality is hard. So this notion that you were writing bug-free code was really part of the faith that the followers brought to the table. That, wow, you could write this code and it will work. Well, in 2016, this is probably the first time I took Ethereum seriously, because for a long time, myself and a group of other skeptics, we'd look at it and say, yeah, this is interesting, but there's no way this is going to take off. We were very, very wrong, but we were wrong for reasons that still to this day make no sense to me, but we were very, very wrong. And suffice it to say, I'm very humble about that. But here's what happened. I paid attention to it. The first time I paid attention to it is when someone other than Ethereum raised $1 million pre-selling their tokens for an application that was going to not be ready for 2 years. I took it seriously because I've worked with entrepreneurs for a long time. I've been in seed stage companies through Series D stage companies, and I know what it takes to raise money. And $1 million is already a number where you're getting some credibility. The next one I saw was at $5 million. That's, in my parlance, it's a Series A round, and that's really hard. You really have to have some product market fit to get there. Then this thing called the DAO. DAO stands for Decentralized Autonomous Organization. It is an organization that is meant to operate where there's nobody in charge. The smart contracts make all the decisions, okay? And so this concept of a DAO is something that people in this world were very enthusiastic about. So they created something called the DAO, which was the very first one, and the DAO was an investment fund. And people submitted their Ethereum or Bitcoin, and what they were saying is that we will the smart contract will invest in projects that the community, all of the holders who invested in this fund, decide, they vote for. So everyone who invested in this DAO would vote and on the projects that were available, and the projects that got the most votes would get some funding. And that was the notion of the DAO. Well, they raised $150 million. It was incredible to watch this happen because we would be getting updates. First of all, it's all visible, it's public, so you can see the DAO number increasing. And I remember at 50, we were floored. At 150, mind blown, okay? So, what happened? Well, when you have $150 million, we term that a honeypot in the hacker world. And that's exactly what began to happen. It attracted a lot of attention. And the attention that it attracted was from really smart people. For them, this is a game, it's a puzzle. And what the way it was positioned is that this is a really good investment to make because the people who should be making it are developers who can inspect the code, because the code is public, so you can inspect the code and see how it all works. So if you can see that it has bugs, tell the community and people will work on fixing this stuff, but you can see it, it's public. Well, a lot of people looked at it, a lot of people saw some things were changed and fixed, and then it went live, and somebody didn't see a very, very small error. And it was an error that you could only see once it was running. And so what and we're not going to say this is a negative hacker, because the way this was all framed to the world was the code is the law. In other words, forget about what we've written this does. The code tells you exactly what it does. Look at the code and you will know what it does. Well, somebody looked at the code, and one of the things the code enabled them to do was to siphon off $80 million into what was called a baby DAO, which was unreachable by anybody except the people who controlled that thing. You couldn't tell who controlled that thing because this is a pseudonymous network. You have no idea. And so what happened is another team jumped in as the White Knights and siphoned off the rest of the funds into another DAO. And so now you have to ask yourself, the White Knights, are they really White Knights? You know, they're doing the same thing the bad guys are doing. Ultimately, this led to one of the most contentious issues in the Ethereum community, which was a term called forking the blockchain. In other words, they decided that they wanted to reverse that transaction. There's no easy way to do it. So the way they did it was to make a copy of that blockchain, but remove that transaction and create a new blockchain. And all of the people involved in the ecosystem would be okay with this because the money was restored. But the purists, people who said blockchains are immutable, that's the whole point, were really, really angry. And again, not because they weren't going to get their money back, but they were angry because they're in it for the philosophy of blockchains up until that point was that they were immutable, that nobody could force you into censoring them. Nobody could force reversing transactions. And all of a sudden, here was a situation where a group of people voted. Now, it was a majority vote, 80% of the voters, but they constituted 20% of the people who had Ethereum. So it looked very self-interested. And so That was probably the first big rift in that community because it violated the community standards. It's like, you know, you're in the Catholic Church and they tell you Jesus Christ didn't exist. You know, it's crazy. This is the kind of thing this was. But anyway, life goes on. They got through it. Ethereum today is still a very high worth valued currency. But this was a very seminal moment, which to Bitcoiners, this is why they'll never, they're very frustrated. The old school Bitcoiners will never advocate for Ethereum because of this event. So when I talked earlier that this is faith-based, I'm not joking. People have strong opinions here. These aren't even political. This is like more than that. This is true faith. All right. So Ethereum really ushered in the age of ICOs. Now, up until Ethereum, when new cryptocurrencies were introduced, it was termed forking, either forking or copying the code. Forking meant you took the existing transaction history and you changed the way that the consensus for creating the blocks was going to go forward. And that would be, so for example, there's a cryptocurrency called Litecoin, which did that. So they said at this point in Bitcoin, we're going to take a copy of the full blockchain and continue it over here. If you had Bitcoin, you'll have Litecoin. But we're going to go in this, actually, let me take that back. In the case of Litecoin, they just took the code. Sorry about that. They didn't take the history. They just took the code. And so they started their own blockchain, but with the exact same code, just different rules around creating blocks. With Bitcoin Cash, which happened recently, that was a scenario where they took the transaction history and changed the rules going forward. And so anybody who had Bitcoin on a certain date about a year and a half ago, when Bitcoin Cash was created, they now had Bitcoin Cash. These are two different blockchains. So the one blockchain is worth a lot less than the other one because it's not perceived to be as valuable on the basis of security, on the basis of how much support it has, but it's still alive and Bitcoin Cash continues. Up and coming blockchains. So there are other people Ethereum motivated a lot of thinking. Ethereum has a number of limitations around scalability, around how it's governed, how people make decisions over changes in the protocol. These are 4 examples of new blockchains where companies have created their own versions. They've done a lot of the hard thinking around how they should be governed, how the algorithms are going to work for consensus. But anyway, so this is the new kids on the block. Many of these have already done ICOs, so their tokens are trading even though nobody is actually using them for anything real. So memes are important. The asset value is outstripping the value of the companies. So companies are being valued for a certain number, but the asset value is far and away bigger. So those companies tend to hold a percentage of those tokens for themselves, and it turns out that the biggest asset on their books is the value of the token, not the software they developed, not the people that they have, not any of those things.